You've probably heard of Which Magazine, our home of hard-hitting journalism and informative stories delivered directly to our members. There's our travel, money and tech mags too. But did you know you can hear some of our best articles for free, available to listen to whenever you like? Each week on the Which Shorts podcast, we bring you a specially selected story, lovingly voiced and produced especially for you on a whole range of fascinating topics. Just search Which Shorts wherever you're listening.
When life gives you questions, Which? Get answers.
Welcome to the Which Money Podcast, your weekly hit of money news and personal finance hacks to help make you better off. I'm your host, Lucia Ariano, and here's what's coming up this week.
If you can put that money away and you do not need to touch it, a fixed rate is brilliant because you have that certainty. If you can't, like many people won't be able to, then it's making that decision about whether you would want to access it 2 or 3 times or whether you need to be able to access that whenever something may arise and you need access to that money.
And it really should be a time to start thinking about shopping around if you haven't already done so, because still far too many people are leaving their money languishing in savings accounts that really do still pay paltry amounts of interest.
This week on the podcast, we're looking at savings. Now, with inflation starting to fall and the Bank of England about to take their next rate-setting meeting next week, there's been a lot of speculation about whether or not interest rates will go down. So with change potentially on the horizon, what might that mean for your savings? Well, we'll be talking about the best deals out there, if you should lock in now or wait and see, and discussing the different types of savings accounts on the market right now. And to help guide us through this, I'm joined by a top panel of saving expert Sam Wilson, one of our market analysts here at Which, and Susannah Streeter from investment platform Hargreaves Lansdown. Hello both, thank you for joining us today.
Hello, it's great to be here. Thanks very much for inviting me. Lots to discuss.
So much to discuss. Well, shall we get into it then? Generally speaking, inflation is down. Now, the Bank of England has been using high interest rates as a tool to get the inflation under control. So has it been working then?
Well, it has to some extent, but the problem is we still have pretty high wage growth. And that's what's concerning Bank of England policymakers. And it's why even if inflation falls below target of 2%, which is expected to do in the months to come, it doesn't necessarily mean that we're going to see a fast cut in interest rates. Policymakers are likely to have a wait and see approach just to make sure that actually those disinflationary pressures really are washing over the economy and that there isn't a risk that inflation suddenly pops up again and then becomes harder to control in the future. So that's why expectations for interest rate cuts are being pushed now away from June to more like August or September.
So for next week then, I feel like maybe I know the answer to this. So the Bank of England's Monetary Policy Committee, they meet about every 6 weeks to decide on interest rates. And the next meeting's on Thursday. Is it possible that we could see rates coming down then?
I think it is a very, very unlikely, I'm afraid. Remember as well, we did see the economy move further away from recession. The indications are anyway growing 0.1% in February, and consumer spending is relatively upbeat. Certainly, many consumers still seem to be shaking off the onerous high borrowing costs. And that wage growth is still problematic, which is why I think they're going to stay in this holding pattern, however painful it may be for borrowers.
Until June, I think you said.
June at the earliest, very earliest. There's still an outside chance, I think, for June, but much more likely to be either later in the summer or now September is being increasingly penciled in. But in the United States, even fewer cuts are now being penciled in because over there, inflation is proving even more stubborn. So maybe we should think ourselves lucky.
I mean, for anyone listening, it might feel quite confusing that, inflation has come down, but interest rates are so slow to follow suit.
Yes, that is because of this high wage growth that we have in the economy right now. And the worry is that if companies are forced to pay more for their talent, for that workforce and form of higher wages, that they will pass on those costs in terms of higher prices that we have to pay for goods and services. And the problem is we still have a pretty high number of vacancies right across the UK economy. Maybe there's a mismatch of skills and experience for the positions that there are available. We know there's high numbers of people who are long-term sick, also not able to work. All of that is kind of conspiring against Bank of England policymakers, that they don't really want to keep rates as high as they are, but they're concerned that actually if they're not prudent and cautious, it could lead to more problems down the line.
And shall we rewind a little bit then? Sam, we're talking about whether or not the Bank of England might change the base rate next week. Can you talk to us about, how it's used to set interest rates on things like savings, loans and mortgages?
Yes, of course. So it's really important for these financial products. The Bank of England base rate determines the interest rate paid to commercial banks that hold money with them. So this directly impacts the rates that banks charge customers to borrow money, and also the rate that they will earn on savings, because it impacts the cost of these products for the providers. So as rates increase, some providers will really look to pass those savings on to customers, but not every provider. So we've seen the big banks, they often aren't passing on that rate increase in the savings, but smaller providers, often those possibly more focused on investments, are passing on the rate increase that we've seen from the Bank of England.
And Sam, it does sound like we're not going to be seeing changes next week, though obviously there is a chance, but let's just talk about it anyway. Let's cover this off. In the event that the base rate does change and interest rates do change, how long does it take for savings products to be affected on the market?
We will probably see the savings market affected before the base rate actually changes. So back in November and December 2023, all the way through to kind of the end of January, when the market kind of expected at that point that something could happen, a base rate change was maybe more likely, we started to see the rates really reduce. So we saw the average 1-year fixed rate savings account fall from 5.13% to 4.62%. Now, those numbers may seem quite abstract. So for context, that's a 0.51% reduction. Since February to May, we've only seen a 0.02% change in the average 1-year fixed savings account. So that is a massive change over just 1 month. So if the Bank of England do indicate that they're going to change rates, the savings market will change very, very quickly, particularly on those fixed term savings accounts. We'll also see variable instant access accounts change very, very quickly, because they are often directly linked to the base rate.
And for savers then, Susannah, I suppose this is quite good news, is it, that rates won't be going down?
It makes a change, doesn't it?
Yeah.
Given that savers really, over the past few years, certainly when we had that era of ultra low rates, they really did feel as they were hard done by. Now, instant access savings accounts, you can still get rates of around 5% for an instant access account. Some of the best savings rates are actually for fixed accounts from 3 to 6 months. And that's because of these interest rate expectations, that interest rates are likely to stay at this elevated level for another 3 to 6 months. And then we're expecting some kind of change downwards. So that's why you're still seeing some pretty good deals on the market right now. And it really should be a time to start thinking about shopping around if you haven't already done so, because still far too many people are leaving their money languishing in savings accounts that really do still pay paltry amounts of interest. And actually there are savings platforms out there that do the hard work for you, where they can really show you all the best rates there on the same page, and you just need to select which rate that you want to go to. And it's much easier than doing all that shopping around yourself. So really, I'd say there's no excuse. Don't be lazy. Try and ensure that your money is working harder for you.
We'll be back in a moment to talk about the different savings products on the market and the best deals available right now.
Scammers are stealing hundreds of millions of pounds every year. They bombard us with fraudulent texts, emails and calls. And what's more, their tactics are getting increasingly sinister. To keep across the latest scams, sign up to our free Scam Alert service to help you stay ahead of the latest scams and protect yourself. Go go to which.co.uk/scamalert-newsletter. That's which.co.uk/scamalert-newsletter. Thank you.
Welcome back. Now let's get into the detail of savings accounts. What are the different options for people with a little bit of money to put away, Sam?
So there are lots of different types of savings accounts, and it can often feel overwhelming to look at the huge array that is out there. But they are all designed for specific purposes. So we can kind of split the different types of savings accounts into instant access, limited access, fixed rate, and regular savers. There are a couple of others, but those are the main ones that we see. So for your instant access accounts, these have variable rates, and that means that they can go up and down over the term. So although currently we're seeing the top rates of instant access accounts over 5%, we do expect that will decrease as the base rate decreases. So there is some risk associated with that. However, with that risk in your rate reducing, you have instant access to your money. So this is excellent if it's savings that you're putting away, but you might need to tap into at different points. You then have limited access accounts, just like instant access accounts. These come with a variable rate. However, they'll often stipulate that you can access them 2 or 3 times. As a result, the rate is often slightly higher because the providers know that you're only going to take so much money out or have the opportunity to take out money 2 or 3 times. And if you do want to take money out more than the amount of times that the provider states in the terms, the rate will often drop quite dramatically. Fixed rate accounts, they're designed for putting away a lump sum of money. We generally see the term lengths for these range all the way from 6 months to 7 years. However, there are only very few providers that will offer 4-year, 6-year and 7-year fixed term savings accounts. There are a few more that will offer 5-year fixed term savings accounts. The key to these accounts is that the rate is fixed at the point that you open the account, so you know the amount of money that you'll get in interest, but you have no access to this money. So you really need to think beforehand about whether you're able to lock it away for the term length. Regular savings accounts can have variable or fixed rates, and these are actually the most popular savings accounts according to our market research. This is probably because they're often added to current accounts, and we actually see the best rates for regular savings accounts attached to current accounts and only available to current account customers. So these are designed not for if you've got a lump sum, but if you want to build up your savings over a period of time. Often they'll be for 12 months or 24 months. And they vary about whether or not you can make withdrawals and whether your rate is impacted on when you make a withdrawal. So for a regular savings account, you really want to have a look at the terms and conditions to see whether you can make withdrawals and if you'll be negatively impacted if you do.
Thanks, Sam. So much you went through there. So for anyone listening, thinking, okay, well, how do I make this decision? How do I choose which type of savings account is best for me? What advice does it boil down to for you?
I think the first thing that you really need to think about is access. So if you can put that money away and you do not need to touch it, a fixed rate is brilliant because you have that certainty. If you can't, like many people won't be able to, then it's making that decision about whether you would want to access it 2 or 3 times or whether you need to be able to access that whenever something may arise and you need access to that money. The next thing that you need to think about is whether you've got a lump sum or whether you're looking to build a savings profile. So if you've already got that lump sum, again, the fixed rate account is going to be brilliant for you. If you're looking to build your savings, something like a regular savings account where the rate is slightly higher, however, you'll only be able to deposit often between £50 and £300 a month is probably the right option for you.
The $1 million question, Susannah, if you want to go first, is now then the time to lock away a good savings rate? Are high interest savings accounts likely to last long? Is now the time to pounce?
It is very difficult to peer into the crystal ball and say it's right now because, of course, remember, in January, actually, we didn't think that this level of savings rates would last, but they have continued. However, what I would say is it's definitely really time to start doing your homework and looking for the best rates around just to make sure that your money is working the hardest for you as possible. Now, remember as well, you should be putting away between 3 to 6 months of essential expenditure as your rainy day pot if there's an emergency that comes up in your life. And there, having an instant access savings account is a really good idea because you can get hold of it quite quickly. And of course, there's some pretty good rates around still. But certainly, I think if you can start saving in and locking your money away, if you've got a longer term project to pay for between 5 and 10 years, for example, on the horizon, and make those regular payments into your savings account, it's a really good habit to make and certainly should set you up for whatever you want to do in the future. And once you've done that as well, perhaps then think about making the most of your stocks and shares ISA allowance as well, because there's a risk, remember, to leaving your money languishing in a savings account, not earning any interest when actually you could get greater returns. We've seen it on a historic basis if you invested in the stock market as well.
And are there any particular standout deals at the moment? Any savings accounts that seem to be a step above the rest?
It's quite difficult to really say that one is much better than the other. But actually, if you go onto the savings platform, Hargreaves Lansdown has one, you can see that there are still some of those instant access savings deals around paying just over 5%. And then I think there are some really good ones as well, paying between 3 and 6 months for a fixed rate for 3 to 6 month period. But of course, remember as well, some of these offers do change pretty quickly. It's difficult to say at any one time that this one building society or bank is the best. And we've seen it as well in the mortgage market. Some of the deals can change quickly depending on the economic data that comes through. If there are indications that wage growth is still pretty high and looks stubborn, it may be that actually some better savings rates pop up. So at any one time, it's quite hard to say which one's the best one to opt for.
And Sam, are there any savings accounts that are kind of at the top of the which tables that we're recommending at the moment?
So currently, Atom Bank account have a 1-year fixed rate savings account at 5.15%. So that is amongst the highest that you are going to find. This is with an initial deposit of £5,000. And they have an excellent mobile app. And they scored 65% in the recent Which customer survey, which is about mid-table. And it was actually a slight drop. But in terms of rate, 5.15% is really quite good. There are a number of other providers. And if you do go onto our best savings accounts page, you will see that there are actually about 8 providers that are offering a rate of 5.1% or higher. So you do have choice. You can have a look and see whether there are accounts that pay interest maybe monthly or yearly on maturity, depending on which one you're looking for. Also, you have the choice to decide whether you'd like an app and to do it all through an app, or whether you'd like to go to the branch and have the security of that, or whether you'd like to do it online. So that is the good thing about the savings market at the moment, that you do have plenty of choice.
And we'll pop links to those in the description of today's show. And Susannah, can we just go back to, you mentioned ISAs a moment ago. Can you just talk to us a bit more about why ISAs can be a useful string to your bow when you're saving? And, is now a good time to open an ISA, given it's the new tax year, new allowances?
Yes, certainly. It is a good time, of course, because the clock starts ticking again at the start of the financial year and your new ISA allowance can be filled up. And of course, we've certainly seen frozen thresholds when it comes to the amount that you can save into a cash ISA at any year. So it's really best to make the most of all the available allowance that you can. And certainly it does mean as well that if you save within that tax wrapper, you don't have to pay tax on that interest you've accrued. And as we've been talking about, the fact that there are really good rates of interest around at the moment, it's even more important that you make sure that you use your available tax wrapper. Interestingly, we've got data out from the Bank of England showing that actually many more people are putting a lot more money into cash ISAs. £3.2 billion flowed into cash ISAs in March. So in the run up to the end of the last tax year. And now early bird investors, early bird savers are starting to put money into their new cash ISAs. So certainly the time is ripe.
And so obviously we've talked about interest rates staying up, if they do, as being good news for savers. But what about for borrowers? Can we bring debt into the conversation? So Susannah, if you've got a mixture of debts and savings, say you've got credit cards or car finance, loans, should you concentrate on paying them off first before putting money away?
Absolutely. You really want to start paying off those debts that really are punishing you with very high rates of interest. So certainly look at paying off credit card debt first before you start to try and save up in a savings account, because your money will be eroded much more quickly if you're paying a lot higher interest in repaying your debt than you would get if you were saving money into your savings account. So certainly look at doing that, paying off that high interest savings account first. Obviously, car finance is difficult. Many people need their cars to go to work. It's very difficult not to pay that alongside a mortgage, for example, or rent. So it's classed as an essential expenditure for many people. So really focus on paying off credit card debt, build up that emergency pot of savings, make sure that you can make the payments on your other obligations, whether it's car loans or mortgages, and then really look at building up a kind of longer term savings plan.
Well, thank you, Susannah and Sam. It's been brilliant to have you both on the show today. We'll have to keep a very close eye on what happens to interest rates and the base rate next week. Don't forget to head to Which Money to get the latest news and the best savings accounts out there. Thank you both for coming on the show today.
Thank you.
Thank you.
Well, a huge thank you again to Susannah and Sam for coming on the show today, and to you for listening to this week's episode of the Which Money podcast. If you enjoyed today's show, please do hit subscribe to make sure you catch our new episodes as soon as they drop. For daily money news and advice, you can find us on social media at Which Money and online at which.co.uk/money. And we also have a free money newsletter which is delivered to your inbox every Monday. To sign up, visit which.co.uk/money newsletter. This episode of the Which Money podcast was written by me, Lucia Ariano, alongside Adrian Bradley, produced by me and Adrian Bradley, and edited by James Rowe.
Like listening to podcasts just like this one from the team at Which? Well, we've got some good news. All our podcasts are now available to listen to on YouTube and YouTube Music. So whether you like listening to Get Answers, Which Shorts or Which Money, all episodes can now be listened to directly on YouTube or through the YouTube Music app. To find them, just search for the podcast you'd like to listen to. YouTube's additional functionality also means that you can now read along with subtitles as you listen. Don't panic though, all Which podcasts are still available to listen to elsewhere too. So wherever you listen, we'll see you soon.